Welcome to The Explainer. Today, we're putting Calian Group under the microscope. In the source material, they're often called Canada's quiet compounder, and for good reason. We're going on a bit of a financial detective hunt today to figure out the whole shebang, what this Ottawa-based outfit actually does, how they generate their cash, and most importantly, what this quiet compounder is genuinely worth in today's market. To do that, here is our roadmap for the breakdown. We're going to meet the company, unpack their four main pillars of revenue, look under the hood at their financial engine, dig up some hidden red flags on the balance sheet, and wrap it all up with a valuation and final verdict. Let's get to it. Starting right off with Section 1, meet Canada's quiet compounder and their path to $1 billion. Okay, the absolutely crucial thing to understand here is their scale. Since going public way back in 1993, Calian has just steadily built itself up, mostly flying completely under the radar. But listen, their ambition? Not quiet at all. They are gunning for $1 billion Canadian in revenue by fiscal year 2026. And they've gotten this close to that massive milestone through a really disciplined mix, part organic growth, part strategic bolt-on acquisitions. So how exactly are they making that money? Let's move to Section 2, 4 pillars of revenue, focusing on mission-critical solutions. Calian pulls in this incredibly sticky recurring revenue across 4 distinct pillars. First up, you've got advanced technologies. We're talking satellite ground systems and NATO defense hardware. Then there's health, which tackles clinical staffing and digital health platforms. Third is learning, providing simulation-based training for the military and corporate sectors. And finally, IT and cyber solutions. But you know what the real takeaway is here? Their client base. A huge chunk of this work is locked in with federal governments and the defense sector. That makes their revenue remarkably recession-resistant. I mean, think about it. Governments simply don't stop needing cybersecurity, healthcare, or military training just because the broader economy takes a dip, right? And that dynamic builds their economic moat. Now, the analysis points out it might be a narrow moat, but it is definitely getting deeper. Calian basically thrives on exceptionally high switching costs. Once they wire their IT systems or custom training programs into a government department, ripping them out is expensive, painfully slow, and frankly, politically risky. Plus, there's a huge human element to this. Calian's personnel hold highly classified security clearances that literally take years to secure. That unique talent pool locks in these massive, multi-year contracts, making it incredibly tough for some random competitor to just swoop in and steal their lunch. All right, moving on to Section 3, the financial engine, cash flow and growth. We get the business model now, but how does that engine actually perform? Well, the track record kind of speaks for itself. Over the past 13 years, they have compounded their revenue at a very solid 10% historical growth rate. And if we look ahead, the 3-year forward estimate is sitting at a highly respectable 8%. They aren't some wildly volatile tech startup. They are a remarkably steady, highly consistent compounding machine. And the fuel running that machine? $48.7 million in free cash flow for fiscal year 2024 alone. Because Calian runs a really capital-light, service-heavy model, a massive chunk of their earnings converts directly into cold, hard cash. Specifically, they have a 68% conversion rate from adjusted EBITDA. That $48.7 million is exactly what funds their aggressive M&A strategy, gobbling up smaller companies while also letting them comfortably pay out a $1.12 per share dividend to their investors. But hey, as any good financial detective knows, no investment is totally bulletproof. That brings us to Section 4, the hidden red flags, accounting illusions. This is where illusion meets reality. If you were to just look up Calian on a standard stock screener, you'd see a reported GAAP earnings per share of about 94 cents. At a glance, that makes the stock look ridiculously expensive, right? Like it's trading at some huge multiple. But actually, scratch that. Their normalized adjusted EPS is closer to $4. So why the huge disconnect? Well, because Calian buys so many companies, they carry these massive non-cash amortization charges on acquired intangibles. It artificially crushes their reported earnings on paper, totally hiding what is actually a much stronger underlying business. However, this next number, this is a genuine red flag called out in the source, and it contrasts pretty sharply with that accounting illusion we just talked about. 3.3 to 4.4%. That is Calian's return on invested capital, or ROIC. Now, currently, this sits below their estimated cost of capital, which is hovering closer to 8 or 9%. Listen, when a company is serially acquiring other businesses, you desperately want to see those acquisitions generating high returns. Right now, they just aren't quite clearing the hurdle. Management is definitely working to improve margins, but as we try to pin down what this company is really worth, this is absolutely a key operational metric you have to keep an eye on.
And honestly, those acquisitions bring some other baggage too. For one, there is $337 million in goodwill and intangibles just sitting on their balance sheet. That is roughly 47% of their total assets. If those businesses they bought start to underperform, Calian is going to have to take impairment charges. Throw in the serial acquisition integration risk. Keep in mind, they bought 3 entire companies in 2024 alone, and a surprisingly low insider ownership of just 1.2%, and you start to see the full picture. The revenue might be super safe, but their corporate strategy requires virtually flawless execution.
Okay, time to pull all these clues together in our final section. Section 5, Valuation and Final Verdict. Let's solve this puzzle. Let's look at what Calian is actually worth based on the hard data, breaking down the intrinsic value scenarios. At the time of this analysis, the stock was trading right around $83. In the base case, right in the middle, the fair value sits between $82 and $90. So what does that mean? It means that $83, the stock is basically fairly valued. It offers almost zero margin of safety. Now, if absolutely everything goes right, the bull case, sure, there's upside to $125. But if defense budgets suddenly get slashed or an acquisition goes sideways, the bear case, you're looking at a pretty steep drop down to the mid-50s. But before we just write this off as fully priced and walk away, let's look at it from one more angle, the PEGI ratio. This is a brilliant little metric that combines the price-to-earnings ratio, the growth rate, and their 1.35% dividend yield. Calian's PEGI ratio is roughly 0.80. As a rule of thumb, anything under 1.0 is considered highly favorable. It signals that despite that $83 price tag, the stock might actually still be incredibly attractive when you adjust for growth. In fact, the analysis frames the stock perfectly through the lens of investing legend Peter Lynch. He would likely look at Calian and classify it as a fast-grower, stalwart hybrid. Lynch famously loved those boring, recession-resistant government revenues. For a value investor, that's a total dream. And he was a massive fan of that PEG ratio we just talked about. Seeing a solid, dividend-paying company consistently turning out 8 to 10% growth with a sub 1.0 PEG, Lynch would probably call this a compelling buy signal all day long. But let's contrast that with the perspective of another legend, Charlie Munger. His verdict would probably echo his famous philosophy, a good business at a fair price. Munger would for sure respect that sticky recurring revenue and the deepening government moat. But as we know, he was totally obsessed with high returns on capital. He would likely demand that Calian's low 3 to 4% ROIC improve significantly before he'd ever be willing to crown this a truly great business. To his way of thinking, it's a solid hold, but it's not exactly a screaming buy at the current valuation. Which leads us directly to the final analytical verdict derived from the data. At exactly $83, Calian is a rock-solid hold. The risk-reward is pretty balanced, but it's just not compelling enough. However, if you are a disciplined value investor hunting for a meaningful 25% margin of safety and a clear path to a 9% annual return, the ideal entry point is definitely lower. You'd really want to wait for some broader market weakness to create a pullback, ideally grabbing it in that $65 to $72 range. So, I am going to leave you with this final thought to chew on. You know the fundamentals are strong, you know those government contracts are incredibly sticky, but you also know the margin of safety is razor thin right now. So, with a base value of $88, do you jump in and buy Canada's quiet compounder today at $83, or do you have the iron discipline to sit on your hands and wait for that drop to $65? Thanks for joining me on this deep dive into the numbers. Keep learning, keep analyzing, and I'll catch you on the next explainer.